Okay, in this video, we're going to talk more specifically about a bond issuance, and then we'll take a look at some disclosures about bonds in a financial statements and footnotes. So first, we'll talk about the issuance, and we're going to talk about the difference between par, discount, and premium. These terms matter for accountants because this kind of determines what the book value of the bond is going to be relative to its face value. So first, let's talk about the coupon rate and its relation to the effective rate, because that totally determines what category we're in here. If the coupon rate is equal to the effective rate, now recall that the coupon rate is the rate of coupon payments that the company is going to make to the investor each year. So the company takes the coupon rate, multiplies by face value of the bond, and that is the cash amount of coupon payment that the company is going to make to the investor. The effective rate is a little different. The effective rate is what the investor needs for their rate of return to invest in this company. So if I'm going to lend money to a company, I'm going to require a certain rate of return. That's what the effective rate is. And these can be compared to one another because they're both expressed in percentage terms. So what does it mean when the coupon rate equals the effective rate? It means that the coupon payments that an investor will receive during the term of the bond, if the investor pays face value, those coupon payments represent exactly the required rate of return that that investor is shooting for, which means that the investor is going to be willing to pay exactly face value for those bonds. So when the coupon rate equals the effective rate, the cash proceeds to the company, which is what the investor is willing to lend to the company, is exactly going to equal the face value of the bond. Now, in the case of a discount, that's when the coupon rate falls short of the effective rate. What is a possible scenario here? Well, imagine a very risky company issuing a bond. If it's a risky company, that company might go bankrupt before making all of these bond payments. So if I'm going to invest, if I'm going to lend money to a very risky company, I need a very high rate of return to make that investment worth my while. But if the company is offering very small coupon payments, the only way for me to achieve that rate of return is by giving them a small amount of money up front in terms of what I'm willing to lend them. So if the coupon rate, and let's just say the coupon rate sucks compared to the effective rate I'm looking for, in order for me to get my required rate of return, I need to lend the company a small amount of money. So those cash proceeds are going to be low relative to face value. On the flip side, imagine a very low risk company. So a big, stable company wants to borrow money from an investor. Well, okay, I'm willing to lend money to a very stable, non-risky company. And then I look at the coupons that they're offering, and they're offering very high coupon payments. And you're thinking, I don't really need a very high rate of return to invest in this low-risk company. And those coupon payments are really high. So I'm actually going to be willing to pay more than face value for that bond because the coupon payments are so huge. So in the case where the coupon payments exceed the effective rate, then the cash proceeds are going to exceed face value. And we'll see why that matters on the next slide. So the next slide is a bond issuance. And this bond issuance is from Nike. It was issued around July 21st, 2016. And right there, staring at you in the face, is the face value. So $500 million is the face value of this bond. Down here below Nike, it says 500 million again, but then it says 3.375%. That's the coupon rate. So this is the bond contract. This bond contract is telling you the face value, the coupon rate, the maturity date, the issuance date. And so this 3.375 is the coupon rate. If an investor wants to know how much am I going to receive each year in terms of coupon payments? Well, you'll take the coupon rate and multiply by the face value. And that's what the coupon payment is going to be each year. And finally, this 2046 year, these notes are due 2046. That's the maturity date. So on the maturity date, that's when the face value gets paid to the investor in the bond. So no matter what the investor lends to the company in exchange for this bond, that investor will receive coupon payments during the term of the bond and will receive a $500 million payoff at the end of the bond. And by the way, it's not a single investor that's investing in these bonds. These bonds are typically in $1,000 face value increments. So an investor might buy $5,000 worth of these bonds, in which case they would receive a $5,000 payoff at the maturity date. Okay, and let's just read this paragraph as well. So Nike says, this is, by the way, this is in a prospectus supplement, which is just a form filed to the SEC website. And the paragraph here says, we are offering $500 million aggregate principal amount of our 3.375 notes due 2046, and we're going to call them the 2046 notes. The 2046 notes will bear interest at a rate of 3.375 per year. So it will bear interest, meaning these are the coupon payments you're going to get. So that's the amount per year. And they will mature on November 1st, 2046. So at maturity date, an investor in these bonds will receive the total face value. Interest on the notes will accrue from October 21st, 2016, and be payable May 1st and November 1st of each year, beginning on May 1st, 2017. So that sentence says, hey, we're going to make these coupon payments, and it's going to be the coupon rate times the face value, but we're going to make half of that payment every half of a year. So we're going to make 2 payments a year. Still, the total coupon payment you're going to get for a year is the coupon rate times the face value. And the final sentence is, the notes will be our senior unsecured obligations and will rank equally with our other unsecured and unsubordinated indebtedness from time to time outstanding. So basically what that sentence says is, when you invest in these bonds, now if we happen to go bankrupt, we being Nike, at what point do you get your money back? And so that is the ranking that they're talking about. Senior bonds get paid off sooner than junior bonds. And any type of bond gets paid off sooner than equity investors. So when a company goes bankrupt, first you pay off your liabilities, then the equity holders get the remainder of whatever is left. That's called the residual interest. And so that's what that last sentence is talking about, is the ranking in case there is a bankruptcy. Okay, so that is the face of the bond that Nike is issuing. And if you scroll down a little bit farther, you get to see what they actually received, because they filed this document right after they issued these bonds. And here's the section that I want to focus on. So per 2046 note, what they're saying is they received 98.899% of face value. That's what they received. Those were proceeds to the company. So this was issued at a discount. There was also some underwriting discounts here. So the proceeds to Nike was a little smaller. Proceeds to Nike was 98% of face value, which equals $490 million. So in short, Nike issued these bonds. The bond had a face value of $500 million, paid a coupon of, I think, 3.375. Investors took a look at that coupon rate and said, you're close. Our required rate of return is just a slight bit higher. So rather than face value, we're going to pay you $490,120,000. And that's in the aggregate. So there were many, many investors that aggregate to the $490,120. And when I say this was proceeds to Nike, this was truly proceeds to Nike. So take a look at this journal entry that Nike would make after they issue this bond. They would do a debit to cash, the asset, and they would get $490 million in cash. And this would be a credit to debt. And this is called the book value of the liability. So this liability has a book value at inception of $490 million. Okay, great. So now let's take a look at, finally, we'll take a look at Nike's footnote. So this is their long-term debt footnote. And here what they have, this is just based on maturity. They're going to list out all of the different bonds that they've issued over time. And let me just show you the entry for this 2046 bond, which is right here. Let's see if I have it circled. I don't have it circled. Okay. So this is the 2046 bond. Here's the column where it says the original principal. Remember, principal is another word for face value. And the original principal for this bond was $500 million. And let's go back. So now we're going to see the book value as of May 31st, 2019 and 2018. 2018 is closer to the issuance date of this bond. So let's take a look at this book value here. Remember, the bond was issued during 2016, and now it's May 31st, 2018. So this bond has been out there in the world for over a year, and its book value is at $490 million. Now, remember the journal entry that we record each year during a bond's term. And part of that journal entry is interest expense. Part of that journal entry is the payment of the coupon payment. And the difference between interest expense and the coupon payment amortizes the book value of the bond towards its face value. So the difference between interest expense and the coupon payment is amortizing the book value of this bond towards its face value. You can see that in 2018, the book value was $490, and in 2019, the book value is $491. So it's making its way up towards face value, which is $500 million. By 2046, that book value will have made it all the way up to face value. And so that's how you can see the accounting working here, is that book value slowly creeping its way up towards face value. Now, if this bond was issued at a premium, its book value would have been greater than face value. So the book value would be working its way down towards face value. If this bond were issued at par, this book value has nowhere to go. It's staying consistently at face value. And that should make sense, because if the bond was issued at par, the effective interest rate is equal to the coupon rate. So the cash coupon payment is going to be exactly equal to interest expense, which means there's no difference. So there's no need to have a plug in that journal entry to amortize the bond's book value towards its face value. Okay, and the final thing I wanted to go over was this disclosure at the bottom, where Nike says the fair value of the company's long-term debt was approximately $3.5 million at May 31st, 2019. And let's just stop there. So what is the fair value of the company's long-term debt? Well, these bonds are actually trading in the market. You can go on E-Trade and buy a portion of this 2046 bond if you want to. What are you going to pay for it? Well, you're going to pay its fair value. That's what you're going to pay for it today. So, okay, let's look at the total long-term debt balance on this footnote. Total long-term debt is at May 31st, 2019 is 3,464. That's the total book value of the long-term debt. The fair value of the long-term debt is 3,524. The fair value is higher than the book value. How could that happen? Well, we know at issuance of a bond, the fair value is exactly equal to its book value. If I go back, the fair value of this bond on this date was $490 million. And that was also the book value on that date. What does it mean that the fair value of the bond is now higher than the book value? And this is on an aggregate basis. So you add all these bonds together and you have an aggregate book value, and you also have an aggregate fair value. So what does it mean that the fair value is higher than the book value? It means that Nike has become less risky since they issued these bonds. So if they were to issue all the same terms, if they were to issue all of these bonds over again today, how much cash proceeds would they get? They'd get 3,524. Well, that's higher than they got when they originally issued the bond. And so that's what that means. The fair value of the bond higher than the current book value means the company has become less risky since they issued those bonds. Okay, so that's a little bit of a complicated topic, but we'll talk about that more in person. So that's what I wanted to go through. I wanted to go through the bonds issuance, par, discount, and premium. Then I wanted to show you some of the information that a company discloses to you as a financial statement user about the bond after issuance. Okay, talk to you next time. Bye-bye.